Washington Journal continues.
Danielle Douglas reports for the Washington Post and is here today to talk to us about the Consumer Financial Protection Bureau's semi-annual report and also explain why House Republicans say the CFPB's Director Richard Cordray's recess appointment was constitutionally invalid, and the House side blocked his testimony before the House Financial Services Committee earlier this week. Welcome to the program.
Thank you for having me.
First, remind us how the Consumer Financial Protection Bureau came into being.
Well, the CFPB comes out of the 2010 Dodd-Frank legislation, which was a sweeping financial overhaul looking at all the various elements of the financial crisis. The CFPB's role was to perform kind of as a middleman for consumers, to allow them to access the best parts of the financial system without having to deal with a lot of the abuses that ran rampant during the crisis. Elizabeth Warren, who's now the senator from Massachusetts, at the time came up with the idea and proposed it in a way that Christopher Dodd and Barney Frank were really interested in, and she helped kind of negotiate the best ways of running the Bureau. Unfortunately, she was not nominated to run the Bureau because her appointment kind of created a lot of political uproar. So Richard Cordray instead was nominated by the president to take that position.
And as of yet, Mr. Cordray has not been confirmed by the Senate, correct?
No, he has not. It's about 20 months since he's been waiting for confirmation.
What's the holdup?
So the Senate Republicans, and in general many Republicans, weren't really happy about the structure of the Bureau. They were hoping that the Bureau would have a 5-member commission rather than a single director. They were also hoping that the Bureau would have to go through Congress rather than the Federal Reserve for its appropriations. And that's not the way that it works, unfortunately. But Senate Democrats are saying this is something that you should have negotiated at the time we were creating the Bureau. It's not up for debate at this point, but Senate Republicans at this juncture are saying we're not going to confirm anyone until you change the structure of this Bureau to make it more accountable and more transparent.
And so while Mr. Cordray was able to testify earlier this week in front of the Senate Banking Committee, he was not permitted to testify in front of the House Committee. Tell us a little bit about that.
So Chairman Jeb Hensarling on the House side said that Richard Cordray's nomination is not constitutional, and he's basing this upon a ruling that came down from the District Circuit Court of Appeals back in, I think, January, that said 3 of the president's appointments during the recess period, which is when Mr. Cordray also came in, 3 of those nominations to the National Labor Board was unconstitutional. There's a separate court case right now that's pending using the exact same argument to unseat Richard Cordray, as well as to generally overturn most of Dodd-Frank. So Hensarling's position is until Mr. Cordray is confirmed by the Senate, he has no standing to present himself as a director before my board. Mr. Hensarling, Representative Hensarling, is chairman of the House Financial Services Committee. He sent this letter on April 22nd saying that the committee cannot legally accept testimony from Richard Cordray on the Consumer Financial Protection Bureau's semi-annual report until he is validly appointed as the Bureau's director, and said Representative Hensarling, the committee's chairman. However, the committee will continue to conduct rigorous oversight of the CFPB. To date, the Senate has not confirmed any nominee to the CFPB director to be the CFPB director, while President Obama purported to appoint Richard Cordray to the position on January 4th, 2012. A unanimous federal appeals court ruling on January 25th, 2013 found the process by which Cordray was appointed was constitutionally invalid. Talk to us a little bit more about the specifics of what kind of oversight the CFPB has. The CFPB probably has one of the broadest oversights of the financial markets. Not only can it supervise and oversee non-financial players, so payday lenders, check cashing stores, debt collectors, credit reporting bureaus, but it also has supervision over a lot of the banks, especially the bigger banks. Many of their supervision works for banks with $10 billion or more in assets, and what they do in terms of mortgage lending, in terms of also payday lending, which is becoming a growing business for a lot of large banks at this point. And so there's been concern among industry groups that the CFPB would kind of I guess, supersede some of the existing regulation. But thus far, industry has responded pretty favorably to the rules that the Bureau has issued.
We're talking with Danielle Douglas of the Washington Post. She's a financial reporter and is here to talk to us about the Consumer Financial Protection Bureau. If you want to get involved in the conversation, the number is 202-585-3881 for Republicans, 202-585-3880 for Democrats, and 202-585-3882 for Independents. If you're calling outside the U.S., the number 282-585-3883. You can also send us messages via Twitter, Facebook, and you can also send us an email. The address journal@c-span.org. Before we get to the phones, I want to take a look at a article that you wrote earlier this week regarding regulators set to rein in banks on payday lending. The rules, which are slated to come out Thursday, could radically alter the operations of the small but growing number of banks, including Wells Fargo and U.S. Bancorp, that offer loans tied to anticipated direct deposits of salary, government benefits, or other income. Critics say these products carry the same abusive high interest rates and balloon payments as the payday loans provided by storefront vendors.
So it's an interesting business. So Wells Fargo has probably been the one bank that's been in this business for the longest. I think 1994 is when they first started offering this product. They call it a direct deposit advance. And it essentially works like a payday loan. You promise to repay this loan as soon as your next deposit comes into your account. But the problem is that often for every $100 that you borrow, you're charged $10. If you calculate it in some respects, that's an annual percentage rate of 200 to 300%, which is pretty standard in payday lending. But regulators are a little concerned that banks are the ones that are getting into this business. On the one hand, with banks being in this part of the business, you know that they are regulated, so consumers are afforded certain kinds of protections that the folks who are going through the storefront vendors may not. Now that the CFPB has jurisdiction over all of the people who are in this part of the market, there will be a bit more of a level playing field. But for right now, the FDIC, the OCC just wants to make sure that these banks aren't taking advantage of consumers.
OCC stands for
Office of the Comptroller of the Currency, and that's the regulator that handles the largest banks, so the Wells Fargos and the PNCs, those guys.
Our first call for Danielle Douglas comes from Barry in Canton, Mississippi, on our line for Democrats. Go ahead, please.
Yes, I am concerned with the protection I have. I filed bankruptcy, and then I gave one figure I was supposed to pay upon monthly, and then it kept escalating till it got to the point I could not pay it. Now they have kicked me out of bankruptcy. I don't know what I'm supposed to do.
So what's interesting about this Consumer Financial Protection Bureau is that they allow consumers like the caller to issue complaints, and they will pretty much broker and monitor what's going on so that whomever the company is that put you into bankruptcy or the debt collector that you might be dealing with at this point, you'll be able to let the Bureau kind of contact them, follow up, and make sure that they can resolve your dispute. So it's always really smart to just give the Bureau a call, have them get involved. They have received about 100,000 complaints to date since they first opened in July 2011.
Next up is Val in Minneapolis, Minnesota, on our line for Independence. Go ahead, Val.
Hi, good morning. Thank you, C-SPAN. I have questions. Why is our president allowing them to basically say that the Consumer Protection Services Bureau, that they're illegitimate, or because without a director, I'm thinking that the organization can't function, right? So why isn't the president doing something about that? The other question I have is, you say that Wells Fargo has been running these payday centers, and you're right. But the thing is this, the public really don't know that if it isn't required that Wells Fargo stay on those payday centers. This is a payday center because I'm a customer of Wells Fargo Bank. When I go to the big bank, there's nothing listed anywhere, even on their literature, that you get as a customer of theirs at the regular bank. You don't get anything anywhere that says, hey, by the way, Wells Fargo customer, we do payday services. You know what I'm saying? A variety of payday services. So why isn't it required that Wells Fargo, like they promote all their other services and advertise them on TV and this and that, why isn't it required that they post that everywhere at the payday lending places and within their larger banks. So, because you could say that Wells Fargo has been running these since 1994, but the general public may not know that.
Danielle Douglas of the Washington Post.
So we'll get at the caller's first question. And one of the things that I think is interesting is that as much as the CFPB needs the director for certain enforcement abilities and also in order to write rules that came out of Dodd-Frank, but for the most part, the Bureau can operate without Mr. Cordray. It still has the ability to do its daily day-to-day operations, but the president wanted to make sure that he was able to write the rules as required by Dodd-Frank, which is why he did the recess appointment back in January 2012. As to the caller's second question, with Wells Fargo, actually, since they don't call it payday lending, a lot of customers might not realize that that's what it is, but on their websites, they sometimes promote, depending on what customer it is, they'll say something like, you may be interested in direct deposit advance, or take a look at our mortgage product. They tend to advertise based upon the demographics of their customers. So some customers might not see these marketing tools, but others might.
Kiki sends us this tweet and says the GOP doesn't want Consumer Financial Protection Bureau, even though their job is to represent the people. And in this debate, it's not so much that the Republicans don't want the CFPB, but they believe that the decisions that have been handed down by the CFPB after the appointment of Cordray are invalid because of the Supreme Court decision, correct?
There are a lot of folks within the Republican camp that believe that. But their essential point is that they want the CFPB to be set up like the SEC is, with members that of both parties that are appointed to the board, so that at no point in time there'll be a political bent either way. But critics say that the SEC at times is stalemated because of the structure and is unable to get a lot of things done as a result, which is debatable. But so far the CFPB has been trudging along and ensuring that they can write as many rules as they're supposed to and get their mandate out.
Our next call for Danielle Douglas of the Washington Post comes from Charlie in El Centro, California, on our line for Independence.
Hello, good morning to both of you, and thank you so much for C-SPAN. Well, here's the predicament that I find myself in with Wells Fargo. Over a 3-day holiday weekend last year, I had a secure Visa credit card and a checking account, and there was basically between $2 and $3 shy of $50 in each one of the $50 for credit or $50 for a check. A check went through there for $50, and Wells Fargo bounced the check from the checking account asking for a cash advance from the Visa card. Of course, there's fees involved in all of this, going back and forth. The credit card will issue the $50 fee, and then it would put itself on notice that we need to have a payment made, and so we request a $50 fee, $50 plus the fees back from the check. And it bounced ping pong back and forth 11 times over a 3-day holiday weekend. When I got there, the opening Tuesday morning, went right to the loan officer or assistant manager of the bank, and I said, I've been, something's going on here. And she said, well, all we know is that you owe us $1,100, and there's nothing we can do, but you can go down to Household Finance right down the street. And I was having my Social Security check deposited there and whatnot, and I just withdrew it. They got all snippy. 7 months later or so, they offered to make settlement for $200 and some odd.
Danielle Douglas.
So what's interesting is that consumers are supposed to be able to opt in or opt out of overdraft, and a lot of consumers, much like the caller, complain of the fact that they're still getting hit with overdraft fees. And so the CFPB, as well as members of Congress who are becoming very concerned about this, want to make sure that banks are offering proper disclosure to all of their customers, that you don't have to overdraft. If you come across a situation where you have a transaction and you don't have sufficient funds, you should just be blocked. So that's one of the things that the Bureau is working on to ensure that there's proper disclosure, because there's still a lot of banks collecting money from overdraft fees.
And I wanted to correct a statement that I had made earlier about the Supreme Court making this decision. It was actually a federal appeals court ruling.
Yes, it was a federal appeals court ruling.
Okay, want to make sure that we get that straight. Cheryl in Springfield, Missouri is on our line for Democrats. Cheryl, you're on the Washington Journal with Danielle Douglas of the Washington Post.
Good morning.
Good morning.
C-SPAN is great. I just wanted to say that, and I want to thank you for taking my call. I had a question in regard to employment and credit. Why is it possible for an employer to deny employment based on your credit history? And if that's true, why and how can they do that?
It is legal for employers to pull your credit history within making that decision. I think that's another thing that the Bureau is looking into to ensure that I think the credit reporting side is accurate. One of the things they found in one of their recent studies is that a lot of times credit reports have lots of errors. And if an employer or even a landlord, if you're renting an apartment, is pulling your credit history and seeing all of these marks that you might not have actually incurred, then that could make it so much more difficult for you to get a job, for you to be able to rent an apartment or get a loan. So that's something that they're starting to deal with.
Our next call comes from Cedric in Winchester, Virginia, on our line for Republicans. Go ahead, Cedric.
Good morning. I have two quick questions, and I'll hang up. One is, why are mainstream banks starting to get into payday loan systems when those systems have known to be predatory in nature? Also, what is the CFPB doing to promote mainstream banking in those areas where it seems like the payday loan system is just taking off and just taking advantage of those folks that really can't afford it?
So banks their argument is with payday lending, they just want to offer the full suite of services to their customers. So a lot of times these are small dollar loans. There's a $500 cap on most of these types of loans. It's for if you have a quick car repair or just kind of need to cover an expense that you might not have anticipated. And so they want to offer that to all of their consumers as they would any other types of financial products. It's still a small percentage of banks that are in this space. Right now, about 6 large banks, Wells Fargo, Regions Bank, U.S. Bank, I believe also Bank of Oklahoma, are playing in the space. But a lot of banks are very leery because of the historical perception of payday loans and also because of the potential risk. So it's not necessarily a market that's going to explode, but regulators just want to make sure that these banks aren't taking advantage. The interesting part is with the OCC, they were planning to issue that update to their rules, I think since 2001 or 2002, because at the time, the regulators had realized that banks were sponsoring some of the storefront payday lenders, and regulators weren't too happy about that. So they issued guidance that said you cannot issue direct payday loans. So some banks kind of circumvented that rule by saying, well, they're not payday loans, they're direct deposit advances, not the exact same product, so we are well within our rights to do it.
We've got a tweet from Jim at Lake Gaston who says payday lending is illegal in North Carolina. So this new process that the mainstream banks are doing, is this another way to circumvent the illegality of payday loans in states like North Carolina?
That's what a lot of consumer groups are concerned about. Payday lending is illegal in 15 states. And even in states where it's legal, there are so many restrictions as to how many loans a consumer can take out, what kind of repayment statutes that banks have to, well, payday lenders have to follow to make sure the consumer could actually repay. And so federal regulators are now saying, we're going to take our cues from what some of these states are doing. We're going to limit the number of loans that can be taken out within a month or within a pay period, because what often happens is consumers end up taking out more of these loans because they can't necessarily cover the first one, and so it becomes a snowball effect. And I think the CFPB actually came out with a study this week as well, looking at the payday industry, and what they found was that the average consumer was taking out 10 loans a year.
Earlier this week, Richard Cordray, the director of the CFPB, testified before the Senate Banking Committee addressing concerns over data gathering, stressing that all information gathered is anonymous. We're going to take a look at what he had to say and then get an explanation from Danielle Douglas a little bit more about what data gathering is and why the CFPB is so concerned.
But I think this is an important difference, and I want to stress it. If by that you mean we're getting information about whether Richard Cordray is paying his mortgage and when and how, that's not the way the data works. What we're getting information about is consumers, you know, how their mortgage performs over time, but it's anonymized.
So Danielle Douglas of the Washington Post, what is this information that the CFPB is gathering? What is this data that they're gathering, and how are they using it?
So the CFPB has always been a very data-driven model. Before they issue anything, they want to do studies and research and gather as much information about how consumers are interacting with the financial markets. So this data collection effort is to kind of track consumer behavior. How are folks shopping for mortgages? How are they using their credit cards? How are they dealing with overdrafts on checking accounts? The Bureau is collecting all of this anonymous data, which means there's nothing identifiable in terms of your name, your social security number, none of the information that you or I would not want the average person to be able to see. They're collecting all of this data, buying some of it from data services that collect the data separately, as well as requesting records from banks in order to get a better sense of how the average person is dealing with the financial industry. The threat, the perceived threat was that folks would be able to tap in, hackers could get at information. But Mr. Cordray, as he explained to the Senate, is that this is anonymous. There is nothing that anyone can use in order to tap into your accounts or to find out any information about you.
We've got another call, this one from Adam in Gretna, Louisiana, on our line for Independence. Adam, you're on the Washington Journal with Danielle Douglas of the Washington Post.
Yes, good morning.
Good morning.
I had a complaint against a mortgage company who had also reported that I had been over 120 days late with a payment, which was totally false. They also received 3 payments from me that was at that time delinquent because my work had gotten slow. But I sent in the 3 payments, and they told me that everything was fine. 28 days later, I received a phone call telling me that I was in the foreclosure department and basically have a good day, and hung up the phone. So I complained to the CFPB department, and I stated my complaint in detail. And they got back with me maybe 90 days later, and they said they found the company that I complained about and not at fault, and basically closed my case. And I said to the representative of CFPB that I had documentations to prove my case, and they basically just kicked me out. I heard nothing else from them, and I'm just at a loss.
Danielle Douglas, are you finished, Adam?
Yes.
Okay, Danielle Douglas.
Adam, the CFPB's one line of defense, not the only one, and I think they would actually recommend to you also to contact ACLU or perhaps any of the attorneys that could help someone in your situation to ensure that you're not placed into foreclosure. It's one thing for them to make that decision, but it's certainly not the end of the road, and it's not the last resort.
Dina James sends this tweet and wants to know what companies who pull your credit report in order to collect on debt that don't exist. Who are these companies, and are they regulated by the CFPB? Is that somewhere where consumers can go for some help?
Yes, debt collectors are regulated by the CFPB, and they are gathering information right now about how best to regulate them in terms of any kind of rules to supervise their activities. Pretty much debt collectors can go to TransUnion or Experian or any of the other credit bureaus and pull your data, but they can use them within their claims. But the CFPB is looking at that right now to ensure that what they're doing is not illegal, and then also to ensure that they're not creating more problems for consumers, which a lot of consumers are saying that's what is happening.
Another tweet from Oversight of GOP. Ms. Douglas, does the CFPB have the authority to examine and regulate small banks and credit unions?
They do, in the sense of their mortgage rules and also the financial products that some of the smaller banks and credit unions may issue. But in terms of, for instance, the direct deposit lending, CFPB is only only responsible for banks with $10 billion or more in assets. So there are some carve-outs here and there for smaller community banks and credit unions.
Back to the phones. Our next call comes from Luis in Stafford, Virginia, on our line for Democrats. Luis, you're on the Washington Journal. Go ahead.
Good morning. My question is, both comment and a question. I'm in the business that I actually get to pull credit on a regular basis, and I see people that are being hurt by this predatory lenders that are making loans to them, payday loans, and these people are going paycheck to paycheck, just following up because they can't afford to pay their payday loan and then pay payments on anything else that they've got outstanding because they've got the payday loan out. And it's just a continual thing for them. Some of them, they can't pay it and end up going into the credit bureau on a negative, and it hurts their credit. And the other comment is that back in the day, the government was going after these so-called mobsters that were doing the same thing, basically loan sharking, because they used some drastic measures to collect their monies. The banks are just a little bit light about it. They're only calling you or hurting you on credit-wise, but isn't that basically the same thing? It's like legalized loan sharking. Before we get an answer, what kind of business are you in that you're checking up on people's credit records? Well, I'm in auto financing, and we actually have to review their credit before they're actually given a loan. And, a lot of them are hurt by those little things in there.
Definitely. A lot of what occurs in the payday lending industry is very questionable, is sometimes unscrupulous. But there are standards, and not all payday lenders engage in the kinds of abusive practices that hurt consumers. But the idea here is to level the playing field, to ensure that the guy on the storefront in Wells Fargo or Regions Bank are all operating on the same level, that none of them are charging excessive fees. They're fully disclosing to consumers, and I think that's a large part of it, is that when you're desperate and you may need money, you're not necessarily paying attention to all the fine print. It's important, and this is what many consumer groups would say, is that all of the fine print should actually be easily accessible and laid out for you, and so that you can compare the two products from a Wells Fargo, from a storefront guy, and get a sense of, well, if I take this out, there's going to be these fees that are going to come along with it. The likelihood of me being able to repay it is not going to be that high based upon my salary. Part of what federal regulators were doing was trying to ensure that banks have a repayment process, or telling consumers that we're not sure based upon your income that you will be able to repay this, and this is a sustainable way for you to borrow money. So it's all about making sure that the playing field is fully leveled across the board, whether it's the large banks or the small guys, to make sure that there aren't consumers that have all types of knocks on their credit report because they needed to repair their car. What elements of the CFPB's semi-annual report seem to be getting the most attention from lawmakers on Capitol Hill? At least at that hearing, the data collection aspect, which was interesting because the biggest part of the actual report focused on the consumer complaints database that they have, which is pretty extensive. The Bureau decided to extend it out, so now it not only covers mortgages and credit cards, but also bank accounts. It looks at, I think, student loans, and of course, because there's still a lot of homeowners that are hurt, 50% of the complaints that they received were about mortgages. I think the next 20% was about credit cards. Most of the mortgages were instances like the caller before, where they were foreclosed upon, unbeknownst to them, that they thought that they were fully paid up and received a foreclosure notice, or were having trouble receiving a loan modification. And with credit cards, a lot of it is not being fully aware of the fees. Disclosure, again, is a very important thing. But so much of the attention was on the data collection side, and this complaint database is pretty extensive. Our next call for Danielle Douglas of the Washington Post comes from Randy in Iron River, Michigan, on our line for independence. Go ahead, Randy.
Yes, Danielle. Good morning. I'd like to ask you if you go out of the United States, and if you can help us with this $192 billion that the drug cartel money just funneled through London Bank, and that's connected to the United States banks.
How much influence does the CFPB have on that kind of trafficking? On money laundering? Yes. Not quite as much as, say, the federal regulators, who have been looking into the money laundering issue. As the caller mentioned, HSBC was the huge bank that was brought in
because of its alleged money laundering for Mexican drug cartels. And they've had to pay some hefty fines, no jail time. But there are a number of other banks that have come across these issues. Most of them really incur because the banks aren't flagging to regulators that, hey, this particular transaction looks suspicious. So it's little things like that. There are not as many cases as an HSBC where there is actual cartel money running through the system. It's lots of little things of not paying attention to things that could be suspicious.
Danielle Douglas is a Washington Post financial and banking reporter. She covers commercial and investment banking and has been with the Post for 2 years. Previously, she reported on the retail and hospitality industries here in the Washington, D.C. area. Our next call comes from Carrie in Lake Zurich, Illinois, on our line for Republicans. Carrie, you're on the Washington Journal. Your question or comment for Danielle Douglas of the Washington Post.
Good morning, Danielle. How are you?
I'm good. How are you doing?
I'm doing well. Hey, I've just got a quick question, and maybe you can clear the air and see what's going on. I know there's been, obviously many foreclosures on mortgages, people underwater, and there still is quite a few out there. Is there anything that's going to happen in the near future, or is there something that's already happening with people that are underwater but current with their mortgages? I know there's and maybe you can explain what they're doing for people that are not current and underwater. And what do you think should happen, or is there a plan to have something that, for people that are current?
Danielle Douglas.
So the little that I do know about what's going on in that space, there is the HAMP program, which came out of the Treasury Department. This is one of the things that came out of the financial crisis to ensure that folks who were struggling to meet their payments weren't going to end up in foreclosure. So if they were delinquent, the banks that issued their mortgage would try to work on some kind of modification, a principal reduction per se, that would help them to be able to become current. There are lots of individual private programs that many of the banks are engaging in, and the other part is that many of the banks who had to settle recent foreclosure settlements, one of the big ones is the $25 billion national mortgage settlement, which involved J.P. Morgan, Wells Fargo, I think Citibank, and Ally Financial as well. They are helping homeowners who may not have received the best care when it came to foreclosure or having issues with their homes. So now they're trying to work through modifications. The other portion is the $9 billion settlement that the federal regulators were able to broker with, I think, about 13 mortgage servicing companies. Now, they're also supposed to institute some help to homeowners who are struggling in the form of principal reductions, interest rate reductions. So a lot of the folks who are eligible for these have probably already found out about that because the banks are supposed to notify them. Others may want to contact local housing counselors to see if they might be eligible for some assistance under any of these settlements, because there are a few of them coming out of the crisis, and a lot of them aim to try to help people who are having trouble with their mortgages.
Bill Ritzman sends us this tweet. He's following us at C-SPAN WJ as well as Danny at Danny Doug Post, and sends this question: is there a mandated process for consumers to have explained to them the risks and obligations of payday loans?
There is disclosure that all payday lenders are supposed to offer to their consumers to make sure that they know exactly what they're getting into. The CFPB is looking at simplifying the disclosure. I mean, I'm sure you or I, when you open a checking account or look at some of these financial products, there are a 20 or 30-page brochure that you get with it that most people are not reading through. A lot of consumer advocates would like to see those types of disclosures whittled down to about 1 or 2 pages, and to offer an easier way for consumers to figure out whether they should be taking these products.
Next up is Renee in Fort Worth, Texas, on our line for Democrats. Go ahead, Renee.
Good morning, Danielle.
Good morning.
My question is for the elderly, and it's kind of aside from the payday lending. A lot of elderly have their checks automatically deposited. The checks are paid on, say, the 3rd, the 1st, whatever. What has been happening, and Chase Bank specifically, what has been happening is that they're holding on to that money, and then depositing into the elderly account on whatever day it is. Are they collecting interest on that money while they're holding it? And if so, that's in the billions. Why hasn't somebody done something about it?
Danielle Douglas.
I do know that the CFPB is looking into the way that banks treat elderly customers and making sure that they're not taking advantage of them. I'm not certain about how Chase operates its release of funds when you deposit your checks. Most places only take a couple of days, but that's something, if you are experiencing that repeatedly, it's something that you should contact the Consumer Bureau about, just to ensure that you're not being taken advantage of.
Next up is Tracy in Stuart, Florida, on our line for Independence. You're on the Washington Journal.
Good morning, Danielle. I have a question to ask. This is reference to catalogs being sent to you pre-approved for credit, and I've been getting a raft of them again. I applied for a credit card recently. The first one I had applied for years, and I was denied. And the reason was I had applied for too many credit applications in the past month or so. I'm not sure exactly how they said the month or so, but it was like a short period of time. And so I understand that these catalogs, when they send you the pre-approved, that this goes to your credit score or whatever, and there's a record of that. And is there anything we can do about that?
So the caller is correct. Every time that you open a line of credit or there is an inference into your credit, that is a knock against your credit score. I'm not aware of anything that's being done in order to address that, unfortunately, but I do know that the Bureau is looking at how some of the credit reporting agencies handle these sorts of things and whether they are being fully transparent and accessible for consumers.
Danielle Douglas of the Washington Post has an undergraduate degree from NYU and a graduate degree from the Columbia School of Journalism. Mary in Wausau, Wisconsin is next on our line for Republicans. Mary, you're on the Washington Journal. Go ahead.
Good morning. Good morning. Danielle, you know, these people that want home mortgages and really don't qualify and they're worried about making payments, I think the government's just not helping them. You know, obviously they're not working hard enough or saving enough money to afford to buy a home, so what's wrong with renting? And then the government doesn't have to control the loan. The person that they're renting from is going to either say, yes, you can stay here another month if you can't afford it and make it up next month.
Mary, we're going to leave it there. Danielle Douglas, talk to us a little bit about what, if anything, the CFPB does in order to protect homeowners or potential homeowners.
Well, one of the things that the Bureau is doing, they instituted a qualified mortgage rule. What that allows for is banks or lenders have to ensure that consumers have the ability to repay the loan. Part of that is instituting a debt-to-income ratio. I think your debt can be no more than 43% of your income. So with that kind of metric, that they're trying to make sure that you could cover your loan if you were to lose your job for perhaps a certain amount of time. But I think one of the things to keep in mind that many homeowners who find themselves in trouble now at one point were able to pay their mortgages and perhaps fell into some troubles that have made it more difficult for them. I think it's interesting to see whether their lenders are willing to work with them after the point, and the government and many consumer groups thinks that banks should be willing to modify loans and to work with customers, especially if they have a proven record of being able to meet their payments.
Danielle Douglas is a financial reporter with the Washington Post and has been here talking to us about the Consumer Financial Protection Bureau. You can read her articles at WashingtonPost.com and follow her on Twitter at DannyDougPost. Thanks for being on the program.
Thanks for having me.
Now we want to take a look at what's coming up on tomorrow's edition of the Washington